Hey everyone, Jeff Rundlet, VP of Institutional Solutions at Cryptio. I've been here for 3 years now, a little over. It's been a really fun time working here. So we're here to talk about what the FASB is up to, how the leading auditors think about all the technical issues that we're going to speak about, and we'll get a little into the weeds, but try to keep it also high level.
Hi everyone, my name is Marissa Scicchitano. I'm an audit principal at Wolf & Company. For those of you that are not familiar with Wolf, we're a 100-year-old CPA firm based in Boston, but have a national presence. And probably most relevant to this conversation is that I co-lead our digital assets group, focused primarily on audit clients. And I've been with Wolf for about 13 years now, so looking forward to discussing with you guys today.
All right, good morning, everybody, or good afternoon. I know this is pre-lunch, so we'll try to make this as fast as possible. Steve Baum, co-leader of CBIZ Crypto. I have known Antoine and Jeff for a long time here, so very excited to be here today. Super excited about this panel. It's amazing what Cryptio is doing, an event that I look forward to every single year. By way of background, I've been in public accounting now for about 15 years. Started my career in public accounting, handling public company audits primarily, really in the emerging tech sector of companies that wanted to go public. 2015, co-founded a digital asset practice at a firm called Friedman. Was purchased by Markham in 2022, and then subsequently purchased by CBIZ in 2024. Currently, my role at CBIZ is focused on nationalizing the crypto practice there and really bringing it across the country. CBIZ is a top 10 accounting firm. We are the only accounting firm right now that is actually a public company traded on New York Stock Exchange, and we are pretty much located everywhere, primarily focusing on high-quality audit and accounting service to the crypto community.
Thanks for that, Steve. I agree fully. This is the best finance conference out there for crypto and digital assets. So very thankful for having this spot here on stage with my friends. Looking forward to this panel. Reza and Roosmalen. I'm a principal at Deloitte in the accounting advisory practice there. I lead our blockchain and digital asset business and broader financial services business there. I help companies work through their technical accounting challenges that could come from either a transaction, going public. I know we had the IPO panel earlier today. That's something that I work on as well. Work very closely, shoulder to shoulder with our audit practice, to try to work through the complex issues. And as you all know, Deloitte's been in this industry for a while. The digital assets practice at Deloitte started over 10 years ago. We never left, even during the crypto winter. We were still there, serving our clients. And this is the time I think we've all been waiting for. There's a lot of action out there. DATs are out there. We're seeing all the news, a lot of pre-IPO activity. So it couldn't be more timely to have this debate here with our friends on stage.
Hello, everybody. I'm Jacob Rodman. I am also from public accounting with a background at KPMG for over 18 years, but I'm currently at the Financial Accounting Standards Board, or the FASB or FASB. You'll hear it said a few different ways throughout the day. And I'm embedded within our team right now working on our digital assets research project, and I'm really super excited, honestly, to be here and talk about some of that, because I think it's a great time for us to share a little bit about what we're thinking about, but also just this is a very valuable opportunity for us to hear and share ideas. And I think, I'll say it throughout the day a few different times, but stakeholders' feedback, what all of you provide to us and as it relates to your views is of paramount importance to the quality of the accounting standard setting that gets set. So I'm just really glad to be here and to share a few thoughts and also to hear back from you.
And I just want to thank the sponsors one more time, because you guys are really the backbone of the industry. You're giving guidance when there really isn't guidance out there, or maybe just not extreme clarity. The FASB did great work 2 years ago. We had Alicia up here speaking about the fair market value accounting. To get there, you guys had to narrow the scope. We had to move fast, and you guys did move fast. But I think where we're at now is that we're ready to start tackling some of the other unanswered questions out there. So Jacob, what is the FASB really focusing on right now? And maybe talk to us about a behind-the-scenes view of what you guys are doing.
Yeah, let's see how far behind the scenes I can go. But before I do, as is customary, a standard disclaimer. So the decisions and positions of the FASB are all made only after an extensive diligence process by the board. So whatever I say today, my views that I share are those only and are my views only. So to understand where we are today and kind of what we're looking into, what we're thinking about, I think just a little bit of background, as you alluded to, about the current accounting standard would be helpful to kind of inform both what we're thinking about, but also just the approach that we're taking to standard setting. I think you heard earlier in some of the morning panels around the pace of change in this industry and how things are developing quickly, that products are changing, transactions are changing. And at the time, the board in 2021 undertook a project, an agenda consultation to really gather feedback from stakeholders around what is happening in this market, what transactions are challenging for folks to account for. And based on that, the board heard that there was a need to take on a project to address the measurement and disclosure and recognition aspects of certain crypto assets at the time. So did that work, analyzed it, and I think what we learned as a part of that was that an incremental or a phased approach to that is really what makes sense in an industry like this, where that much activity is occurring and developing that quickly. So the scope of that standard really addressed most of what was prevalent as the questions that existed at the time. There was some discussion even then around the nature of the scope of that project, which excludes certain assets that give rights to other assets or other services. For example, wrap tokens or things of that nature, whether or not those should be in the scope or not. And I think even then there were some questions, but like I mentioned, the standard addressed probably what was most prevalent then. I guess if you haven't heard about and don't know a lot about the FASB, an agenda consultation process is not necessarily a poll by which we just gather a lot of input, but it's really a way for stakeholders to give feedback back to the FASB around what the priorities of the board should be, what sort of topics we should take on for standard setting, and also to offer suggestions about what a good solution might be. So stay engaged and provide us feedback, because that's the way that your views can be incorporated and be heard. I guess jumping forward to 2025, the FASB undertook an additional agenda consultation that kicked off back in January of this year. And as part of that, with the process of which just closed, the staff presented the reactions and the feedback we got on that to the board in its October 8th meeting. And over 72 topics were identified as part of that feedback about priorities that individuals have as it relates to accounting standard setting. I think there was something over 1,200 pages and 130 or so different letters we got. But crypto really rose to the top, and maybe a top 10 topic that was highlighted then of things that the board should consider. Some of the themes that we heard as part of that included that, as I mentioned, the scope of that prior standard relating to fair value accounting, that folks think that new asset classes exist, new types of assets exist now that might need to be reevaluated for potentially being included within the scope of that. And I think, as I mentioned, some of those things relate to largely when assets give rights to other assets or services. Other things we heard include the accounting, primarily the classification for stablecoins, which I know we're going to talk about a little bit later, hopefully in this session. Transfers and derecognition, so we're probably going to talk about that too. Things like lending, staking, liquid staking, pooling, those types of transactions have proliferated, and I think that has risen as it comes to feedback of what we heard from stakeholders about areas that maybe need some new accounting guidance, at least from the perspective of what we heard. And then gross versus net presentation, I think particularly for crypto trading platforms and intermediaries, that really has arisen as a pain point we've heard. And so I think I've got a few nods on the panelists here that a few folks have seen some of the challenges there. And then tokenization, just generally bringing things on chain. Questions around, does that really change the economics and the nature of what is underlying that thing that's represented as a digital asset now, or is there a new accounting model that's really needed, or do existing models address some of that despite the fact that its ownership might be conveyed digitally? So those are the issues that got brought up. The FASB did add a research agenda project to its agenda recently in August. Again, a little bit of background. Research agenda is controlled by the FASB chair, and projects get added to that when there's more information that is needed to assess the project, but likely when there is an accounting result or an answer that makes sense. And then the technical agenda is controlled by the board of the FASB and is really consisting of projects that are on their way towards accounting standard setting. So the research agenda project got added. It includes digital assets with a couple of initial focus areas, kind of those areas that I mentioned we heard about feedback, which include classification of stablecoins, as well as the derecognition and transfers projects that I mentioned. So the FASB staff is actively researching and engaging with outreach participants around those areas now. And I would just say kind of stay involved and look out in the near term for what we might be doing on that front, hopefully in the near term. I guess I'll pause there and maybe just throw it over to any of my fellow panelists maybe to see what you guys think about the agenda.
Can I ask a question? I know, so that's super helpful, like to give that picture, right? And I know it's a lot. Just maybe for our benefit to understand, of course, with the current administration, very pro crypto SEC. Like I heard, Chair Atkins speak last week, and when he was asked, what are the priorities of the SEC? He said crypto is number one, number two is crypto, number three is blockchain, right? And is there a similar wind kind of blowing through the FASB at the moment with the rush, kind of what people are trying to accomplish with this industry?
Yeah, I think, as I mentioned, the feedback that we get really does help to drive the prioritization of topics. And so, like I mentioned, there were 72 different themes or areas that we heard as part of that most recent agenda consultation. Crypto was in the top 10, but there were 9 other items in the top 10 as well. And so it definitely is a focus area, and kind of putting it on our research agenda does devote a good amount of our attention to it and creates a priority for us to focus on. I think other input that we've heard, obviously the Genius Act passage creates a kind of a tailwind, towards regulatory clarity in a few of these types of assets. The Presidential Working Group on Digital Asset Markets, I think, suggested some things for the FASB to consider as well related to crypto accounting standard setting. So it's definitely a focus area and one that, has been raised in priority as things we think about.
Let's talk accounting.
Yeah, let's jump into stablecoins. It's what we said, the low-hanging fruit. Genius Act came out. What kind of questions are being asked? And I think the main topic here is that they're not being held as cash or cash equivalents currently. But how do we move it forward, and should it be considered cash or cash equivalents?
Yeah, it's funny actually, because I feel like the industry is not necessarily waiting for the FASB to come to a conclusion here. There's been a lot of news out there, the SEC making statements indicating what could potentially be classified as cash and cash equivalent, a covered stablecoin. For those of you who may not be, fully up to speed, essentially, if a stablecoin has fully backed reserves by something that's very liquid, cash equivalents, money markets, U.S. Treasury bills, there's a case that it can be cash and cash equivalents as opposed to digital assets. And then, there's other criteria as well. It needs to be a payment stablecoin or a store of value, not necessarily something that bears yield or interest, or for investment purposes. Needs to be easily redeemable, so investors can take their money out and liquidate it fairly quickly. So that being said, I feel like that brings up some auditing challenges. While there's majority of companies out there are using USDC and PayPal stablecoin, there's going to be the more nuanced stablecoins or unique ones that don't necessarily immediately meet that criteria. So it's going to be on management and the issuer to come up with, prove to the auditors and prove to the industry that your stablecoin can meet this cash and cash equivalent. So, I think about, from my perspective as the auditor here, what we'd be needing to look at there, and was it the proof of reserve attestation done by a CPA firm, or even those, you have to take with a grain of salt because it's at a specific point in time, or maybe a random day in the month, but it's not a real-time attestation. So how do we know that these reserves are very liquid as they say they are? Looking at control environments at these issuers, whether it be offshore, onshore, how they're managing their wallet security, and kind of a whole range of things that we need to look at as auditors to say, hey, if you guys are classifying these as cash equivalents, how can we get comfortable with that? So kind of just my initial thoughts on the classification issue. But like I said, it seems, it's something we're dealing with right now because people aren't necessarily waiting for FASB to make a conclusion.
Yeah, I'll jump on Marissa's topic there a little bit, where we're, people on this panel, the three of us are in this industry, and Jacob's obviously really trying to drive the industry forward through adoption of new standards, et cetera, which is great work. But the individuals in this room and us, I'm an auditor, we need to solve this now. We can't wait for a year to determine classification of something. We have to come to a conclusion to provide feedback to clients or to stakeholders to give them the best information that they could use to read financial information. So if a user of financials is getting information that doesn't make any sense, then the audit or the financial information isn't relevant. So it is important to us as auditors to come to conclusions that are good for the industry in a way that allows stakeholders and allows users of the financial information to use that the best possible way. So like the gross versus net example, if we gross everything up, does that help financial users make a better decision on the financial health of that business? Those are the questions we should be asking. I've been in this industry for about 10 years now. I remember in 2015 through basically 2018, we always had Bitcoin on the balance sheet, and we just said, yeah, it makes sense, fair value it. It just makes sense. Why would you not fair value an asset that has a legitimate marketplace? And then in 2018, AICPA comes out with this cost-less impairment. We do that for a couple of years. FASB comes back and says, yeah, it makes no sense, right? So we're in this same cycle. New topics, but same cycle. We need to come to conclusions that make sense for the users of our financial information to ensure that we're providing accurate data to stakeholders. That is the most important factor here, and we need to solve those problems now. So, I think FASB's two topics that they're looking at is cash and cash equivalents or derecognition. When I see it, I talk to my clients about it. Fine, we want to make it cash or cash equivalent, or we put it as line number 2 and call it stable coins. Not a major impact to financial users, right? We could see that. We know what those are. We know those are dollars in the bank. The stable coins have an active market. Same with derecognition, right? Right now, the problem with derecognition is that these are not considered financial assets under the determination of GAAP, which does not allow us to apply derecognition guidance, which ultimately could create a scenario where you're holding up multiple assets that maybe you own one, but you also have a liability associated with that asset. So it's pretty clear to me that we need to create a guideline that says these should be within the scope of financial assets so we can derecognize on-chain, asset that goes to a liquidity pool that I get an LP token back for. Those are things that, I think we should be able to resolve fairly quickly, and then we could start to jump into some of the complex stuff, right? How do we deal with token compensation? For most of these companies out here who have their own tokens, how do we deal with that? How do we handle the gross versus net issues for staking, infrastructure providers? Things that start to become very, very complex of understanding the gap, but also understanding the reality.
Yeah, maybe if I may, just one more minute on stablecoins, because I appreciate, yes, this should be the low-hanging fruit, right? This could be the genius act of the FASB when it comes to like the whole slew of 72 issues that we have to go through. It does make an impact, right? Like working capital is a KPI for many companies, right? So cash is important. This classification is important. And I also appreciate that it's hard in this industry that is innovating so fast and has numerous types of coins to put a broad brush and say all of the stable coins, should be cash. That is probably a bridge too far. But we do have this thing now called the Genius Act, and it does have a definition in there, and we can lean on it, right? And yes, we don't want like any more, we all remember Do Kwon and Terra Luna stable coins to be qualified as cash. But I also want to point out that we have other cash equivalents today that are not legal form cash, right? Like investments in certain money market funds are cash equivalents, right? Their nature, technically they're equity, right? But we think by looking through, it's okay to classify these as cash. And then just one word of caution, when it's cash equivalent, it has to go in the cash flow statement. So that is not going to be easy, right, for certain stable coins.
It's better to show it, though. No, because then it's just in cash, right? Right now, we're carving out stable coins as a non-cash item in a cash flow. It's crazy. We're showing purchases of stable coins, things like that, in non-cash item. And it's very challenging, and it makes the cash flow unusable. So these are the types of things that start to become more important to resolve. But, I agree.
I think it's also going to impact revenue too, right? Because when you have someone transacting from stablecoin to cash, historically that might have been a transaction that would be accounted for as a revenue transaction, and now it's just moving cash to another form of cash. So it's going to change a lot of things, once the determination's made, or even applying it now, like I said earlier.
Yeah, and I might just share a little bit about kind of the FASB's thoughts around stablecoins and what we're looking at right now. I think we've said the concept, or thrown out the concept of what is a financial asset a couple of times here, and generally the definition is it's an asset that gives a right to cash, or a contractual right to cash, or maybe another financial asset from a second party. I think some people think stablecoins, at least some of them, are currently financial assets, or may be viewed as financial assets if they do give that right to cash. But it's not a consistent definition, and I think that assessment is challenging for a number of folks. And so we have heard a good amount of feedback that while maybe some people are able to reach answers on maybe the simpler cases, that some clarity would be helpful there from the accounting standard setter. And so, we are looking into that right now. The board's recent meeting summarizing the agenda consultation highlighted some of the feedback we got about stablecoins, and some suggested clarifying the financial asset concept, as you said, but also amending that cash equivalent definition for some of those ones that, as you mentioned, Melissa, that are highly liquid, readily convertible to known amounts of cash or fiat currency, and that are fully collateralized by short-term, highly liquid assets to be some of those basic characteristics that at least were highlighted to us to think about. So value stability, collateral, and redemption are all part of the discussions we're having, as well as just how that aligns with the Genius Act. The Genius Act doesn't promulgate any accounting standard, but it does actually say that certain stablecoins that are not issued under the Genius Act cannot be accounting or a cash equivalent for accounting purposes. So there's some complexities and overlap there that companies have to think about. So be on the lookout for some upcoming board meetings to see how this topic progresses, and hopefully we'll be talking about it soon.
One last thought on stablecoins. What about valuations? I know FASB doesn't usually touch on that, but what should companies value their stablecoins at? Does it go hand in hand with being redeemable and marking it to $1, or do you mark it to what you have at your principal market, maybe 1.0005, and dealing with the small gains and losses from that? And
yeah, I think this goes back to what Marissa was saying before about the auditability of it as well. If you know that there's a proof of reserve report or something that you could support that you think it's worth one and the redeemable aspect is supported, then I think you could use that as the fundamental for the valuation. If you don't, like an algorithmic stablecoin like a Terra Luna, then of course you need to go to the actual open markets to determine what the value is.
let's move on to DeFi, derecognition and control. I think this one's probably the hardest topic to actually tackle, but it's a topic everyone's really dealing with. And then on top of that, we'll also dig more into the gross versus net. Steve, I'd love to hear your thoughts on the gross versus net, some of the war stories you're seeing, maybe some impacts of dealing with it both ways, and how you're dealing with it.
Well, these topics are very different, DeFi and gross versus net, but I'll touch high level on both.
Putting the rest of the topics out there.
Yeah, so the gross versus net, there's two major situations we're seeing here. One is mainly through OTC desk, OTC traders that are really trading out of their own inventory, that don't operate true order books like an exchange. So, when you have a true exchange like a Coinbase or a Kraken or a Gemini, you have an order book flow that you are basically two counterparts are trading through, and they're collecting a fee. That fee is net. You're able to show it that way because you are not taking inventory risk. In an OTC desk, as more of an operational trader trading out of their own inventory, you're basically matching orders from other exchanges to map to the best option for that buyer. Now, that typically under GAAP right now is going to be treated as principal. What that does, if anyone's looked at Galaxy's financials, I know there was the IPO panel. If you look at Galaxy's financial, they're very, very hard to understand because there's all grossed up assets. So they're going to show like $7 billion in trading revenue and $6.988 billion of trading cost. Okay, so it makes it very challenging to understand the true impact of that financial information. So that's on the OTC desk side, gross versus net. I'm not saying it's wrong, but the technical gap right now is pushing us towards principal, which we should think about. Does that make the most sense for users?
And maybe just to stay on gross versus net, right? It's probably easier to just finish that topic.
I wanted to talk staking too, but go
Sure,
talk
yeah.
the OTC stuff.
So I think you're 100% right. I think what we're seeing right now is all these companies go public, right? They're going to have to give revenue projections out there, their KPIs out there. This number is so hard to predict, and it's effectively your transaction volume, which like no other brokers out there really are putting through their income statement, right? So while I think the answer is where you get based on GAAP, does this provide good information? And these companies, to your point, right, they have 6% gross margin. Like it's
Lower,
even lower than that, right?
And
Like,
you're talking 1.5% fees on some of them, maybe 2% fees, right?
and then the pre-IPO companies that are also dealing with this issue, they're looking at this as part of their EGC test in terms of how many years of historical financials they need to prepare. And they automatically get disqualified as an EGC purely on the basis of this accounting outcome and have to prepare 3 years of financials. It's a significant competitive disadvantage.
And 404B.
And SOX, you got to do SOX earlier. It's a significant disadvantage.
That's control testing for everyone who doesn't know what a 404B is, but
Right.
control test. So it's not allowing smaller companies to get to the public markets.
It's exactly right. So this is going completely against, I think, the idea of growth companies being able to go public in an easier way. And so it comes from an accounting issue, but the downstream consequences, I just wanted to quickly put a spotlight on those.
Yeah, to Reza's point too, broker-dealers do the same thing, but they're exempt from this type of treatment because they're carved out in a specific guidance by the SEC. So comparatively to when you see brokers, they're not reporting it gross because they don't have to. They're exempt. So these are certain things that make it. Well, I'm looking at a broker. I look at this crypto company who's basically a broker, but they report completely different things. How do I understand this? So those are some of the things that we're seeing. Moving to the staking topic. Staking, you're seeing all these DATs starting to come in now. We're seeing DATs, digital asset treasury businesses. We're also seeing staking infrastructure providers starting to go to markets. There's a big divergence in the industry of how to report staking rewards revenue of a company that is running a validator. So if you're running a validator as a transactional revenue stream, you're interacting directly with the blockchain by running that validator. Are you the principal in all rewards that actual validator generates on the blockchain? Meaning that would you gross up all rewards that go to that validator, including delegated rewards that you never touch, you never have rights to, and you never gain ownership of? Again, going back to Galaxy's financials, you'll see that in their S1, where you'll actually see them go in and say that gross rewards from validation is actually going to include their own commission rewards from the validator, along with delegation rewards. So rewards that they potentially never touch. So this is another topic that we're really looking heavily into to understand a little bit more about who is providing the service, who is the principal in the service, and does it really make sense for a company who's just running a piece of technology to be reporting revenue on assets that they do not control?
Yeah, and I think that kind of brings into your point earlier is if someone's looking at these financial statements of a DAT that's running a validator and staking rewards and for other individuals or for other companies as well staking, does anybody really care if they earn these rewards for somebody else that they're immediately remitting back to the other company? So I think that's kind of where we get into who's using these financial statements. Is that going to be something that they want to look at? And this company's now being a accelerated filer, 404B requirements, internal control testing because they happen to be operating in this business. So does it discourage companies from wanting to participate and act in these capacities if they're going to have to be subject to certain accounting rules? So certainly something that we're thinking about and questioning. Does it really make sense to have this?
But think about this too. Reza said it from a KPI perspective. If I'm a company, I'm running a staking infrastructure company, and I want to go public and I want to increase gross revenue, what do? I could just reduce my validator fee to 0. I want to gain more access to delegation. I could just reduce my fee to 0 or close to 0, juice up top line revenue, even though my top line revenue has no margin to it. That's not an appropriate way to be starting to think about getting companies to the public market.
Well, I think, and you said it, right? Like, a lot of these concepts, while, you know, in 2025 or like sooner, of course, have been modernized using blockchain technology, they have different names, but economically, a lot of these transactions are old, right? Like in traditional finance, we've had staking, what's called securities lending, right? Like, and there is accounting standards that have been thought through for years to really distinguish between control and you know, when you know, really give up economic risk and rewards. And I think that type of lens is really necessary to look at these activities for crypto companies to get to like the sensible accounting rather than these gymnastics that we have to do right now to get somewhere, right?
And Reza, you're kind of raising the question, it seems that the distinction of the challenge is because they're considered intangibles rather than financial assets. Is that often why the result occurs?
I think so. I think the intangible standard has not been written for digital assets,
Right.
Like, and or for financial activities more broadly. I think that is actually the real issue. We didn't have a mark-to-market model until like the FASB had to step in. Like the intangible asset standard has not been developed for any type of asset that is being actively traded around, being used in payments. That's just not what that is,
Yeah.
right? Like, so it's, to me, like there's kind of like two options, right? Like include digital assets in the financial asset and financial liability frameworks, and I think you cover off probably a lot, not 100%. You still have to kind of like do more work, or you build out a fresh digital asset standard underneath the intangible asset guidance, right? Like, but like we don't have either of those today.
Yeah.
Right?
I mean,
It's
there's
not just the assets though, too. Just a quick point.
Okay.
It's also the companies and the way they do business, right? So it's one thing to say that the financial, you know, like they're intangibles, but if a company's running essentially a broker house, but they're not able to account as a broker because they're not trading securities, then it's not just about the underlying. It's also about the entity itself and how they're perceived by regulators.
Yeah, I was just going to say that the financial asset definition exists, and I kind of think does require a contractual right to cash, right? And so there is a distinction between those crypto that maybe do give that right and those that do not, which are more considered to be intangible assets. And then the question of what are they in scope to the fair value accounting or not also arises. But if you're in that intangible guidance world, the derecognition questions kind of push you into the existing revenue accounting standard models, right, which have some indicators of control that I think a lot of folks would say make some sense, or at least we've heard make some sense related to derecognition for these things. But there are the prohibitions around repurchase activities as well that might create some challenges from what we've heard back from stakeholders around a lot of these staking lending activities that are occurring with these crypto assets subject to that kind of transfer or derecognition. I think we've also heard, though, that there might be challenges, even if they are considered to be financial assets, around whether they can also achieve maybe derecognition answers that they economically think make sense. And so I think both types of assets can create some challenges, at least from what we're hearing.
I agree. It's not going to be done, right? Like by just being able to call it financial asset, you're not done. I think there is a lot in gap today that really hinges on the legal form in which transactions get accomplished. And in the digital asset industry, fundamentally different. The legal forms that we know from traditional finance do not apply in this space. These are DAOs, these are foundations, these are tokens, these are blockchain protocols, things moving around the internet. But economically, what is it trying to accomplish, right? So I think that is part of the challenge here, that yes, a lot of the existing derecognition guidance or broader financial asset guidance comes down to like legal concepts that we got used to, which for digital assets, quite frankly, don't apply, right?
Just to touch base on because I think a lot of people are probably wondering this on just liquid staking, right? That's another aspect where right now we're seeing a lot of DATs go to market and being forced to do cost-less impairment for those like LP tokens that might represent the actual staking protocol. So this is happening when you have smart contracts building off. A lot of it's with Ethereum because of the 32 minimum requirement on a validator, where you're able to break that up through liquid staking and other protocols. But you're getting the rights to a token now that you have to keep at cost. You know, when I look at the actual FASB guidance on wrap tokens, I don't necessarily understand what we're really referring to there still, because when I see it, there's only two types of coins that really should be at cost, and it's really NFTs and then tokens that are issued by the entity itself. or a related party. So when you start to talk about wrapped tokens, what is that, right? If I take a Bitcoin and I give it to somebody to get a wrapped Bitcoin, and that's now on the Ethereum blockchain, that wrapped Bitcoin is being traded on the Ethereum blockchain at its own price point. So I just basically got another asset that I should be able to fair value. So I don't really understand where we're getting with this wrapped token being at cost. So that's an area that I would push back at the FASB and say we need to look at that and make a really better determination of what we're trying to reference when we say wrapped tokens shouldn't be at fair value.
So we blew through this. I think we have about 10 minutes left, and I want to make sure we leave some questions. A lot of accountants, a lot of finance people out here, and see what our panelists have to say. So we'd love to open it up to questions. James?
James is ready.
Can we? Yep.
So the accounting and auditing panel earlier mentioned that progress is made incrementally, and there's a lot of innovation in this space. I think a lot of the issue we run into on the path to aligning accounting with economic reality, it's really hard to, every issue could potentially become pervasive material eventually. If not immediately, it could because of the nature of this industry. So how should we prioritize what's up next in the road in terms of what to focus our effort on and fixing those gaps? And what would that road look like, I guess, in the next 6 to 12 months and possibly longer, but hopefully sooner?
Yeah, I'm guessing that question's primarily for me. So the agenda criteria that the board considers when it thinks about how to prioritize putting a project on its technical agenda, i.e. leading towards accounting standard setting, includes a few things. The first of which is pervasiveness. So just how big of an impact does this have? Is it likely to be a significant need for a fix, or is it a relatively more targeted aspect that maybe there isn't enough clarity and or it hasn't become large enough yet to address? So I think that balancing both, there is a lot of new development and activity that's occurring with things are growing, and there's a priority that we have to consider when it relates to pervasiveness, that's something that we're always thinking about. But secondly, it's also just, is there an identifiable scope, and is there a proposed solution that is feasible, right? Does the cost-benefit analysis weigh and make sense there too? So we've heard a lot of good feedback, and I think thankfully none of the topics we talked about today are new areas that we hadn't necessarily received as part of other outreach that we'd already heard about from folks like you who are engaged, and we definitely appreciate that. As I mentioned, that kind of how we do accounting standard setting, is it phased approach? Is it incremental? Is it trying to create an entire new model that addresses everything right now? Does have to consider both those agenda criteria aspects I mentioned, but also just like you say, that pace of change, and when new consensus is gaining around an area, or there's clarity that's developing in an area, I think those are the things that we can then start to really coalesce around understanding and moving towards addressing from an accounting standard setting perspective. So all of the areas I said we'd heard about, which is really inclusive of everything that we talked about today, will ultimately be coming back to the board in a series of meetings, starting this fall and kind of over the next cycle as part of that agenda consultation process I mentioned, that the board has to come back and address and hear and then kind of think about all of those topics. And so I mentioned the two priority kind of initial focus areas being stablecoins and derecognition lending, but kind of all the rest of this will ultimately be going back to the board as well. So again, thank you for your thoughts, and also continue to provide them as it's helpful to us.
Well, I like this question too, because I feel like a lot of what we talked about today bring up more questions and issues, and hey, how are we thinking about it? But there's no clear black and white yes or no answer to anything we've talked about. So I like to kind of put it out there that, things that companies can be doing today, what can you be doing to stay ahead of the current guidance and where things are going? While things may not be black and white, making sure you have data cleanliness and all of your data is organized, exportable, ready to go, so that when your auditors are asking for it, or maybe you can make a gross down for your rev rec at some point when the FASB comes out with something on gross versus net. Having your custody and your valuation written down, and understand your policies and your key management, your controls, and getting your internal policies in line. And then I would say the third thing is just making sure you have your experts engaged, get your auditors and your accountants lined up, your advisory firms, so that when things do change, you can stay ahead of it Smaller companies, we know, are not expected to have somebody sitting in on every FASB meeting or reading every FASB agenda, but just rely on the experts that you have surrounding you to help proactively give you that guidance as it does come out.
Any other questions?
Yeah, Marissa, use Cryptio is really, right? Yeah.
Thank you, Steve.
The auditors.
Got it now. Panel mentioned a lot of consensus on income statement gross up, balance sheet classification, what the industry is seeing. Could you guys take a moment on some transaction flows or things in DeFi that there's not a lot of consensus on? Some of the things that you might be struggling with current audits or looking for more authoritative guidance that we're not talking about today.
Yeah.
And you know, Stephen mentioned token comp workflows, like that hits home for my line of work, so it's confusing, but those types of areas are helpful.
All right. I can give you a token comp. That's an easy one. So 710, I think, is the right answer there. ASC 710, which is deferred compensation arrangements. So it sucks because you got to revalue it. Could make up some crazy swings in your income statement. May make not any, it sometimes makes no sense at all. But you're basically being forced to revalue any token rewards that you have yet to deliver to employees, and you're going to have to put up a liability for that. So, you know, the offset would run through token compensation. That offset could be a gain or a loss. I've had situations where we're picking up $1 billion gain in a year because the token fell in value, and then when it goes up, you're going to take a huge expense. The best thing, if you have tokens and you are giving them out for compensation, the best thing you could do is send them out before the year's over, and you won't have to worry about any of this. So just give them to your employees, don't hold them, and then it makes it a lot easier for you. On the second side of it, the transaction that I would say is DeFi interaction with smart contracts. This is a very challenging area because certain smart contracts at times may not be fully decentralized, may have a little bit more centralized control. So you start to kind of think about, well, what am I really working with here? Is it really another aspect of an autonomous contract, or is it controlled by a third party? Am I using that third party? Should there be a SOC report on that? Those are an area that I think is probably hairy. I don't even want to talk about it because it's a little too hairy.
Yeah, DeFi is probably one of the more hairy issues, specifically while auditing as well, because you're not dealing with a legal entity, you're dealing with another smart contract on the other end of a transaction. They don't have a SOC report. They're not going to have somebody who's going to be on the other end of that responding to an audit confirmation. So how do you get comfortable over not only control, which we've been talking a lot about, and when you relinquish control, but also the existence of it. So I kind of try to think about it sometimes like an inventory observation, where you can perform that inventory observation on the day of year end, but oftentimes you're looking at this DeFi protocol and activity that's happened 6 months later. So is it a rollback? Is it reviewing some flow of funds coming off? And you know, the existing accounting and auditing models don't really work for DeFi, so you just kind of have to get creative in many ways.
Yeah, maybe a similar angle. I think, you know, auditability is something that a lot of, you know, the firms are struggling with in this industry, right? It's not even too long ago that I think there was a moratorium on audit clients in this space at some of the firms, and you know, obviously with all the action right now, like a lot of firms just kind of come around from that, but that doesn't mean for clients that it's going to be a slam dunk, that you pick up the phone and you say, I need an audit, like, you know, can you come and audit me? That the audit firm is going to say yes or do that right away. Like they're going to go through rigorous diligence. All the firms are still pretty, like, you know, skeptical around the industry, right? And it's risk averse, and there's not a lot of guidance. And yes, areas like DeFi, areas like the controls that you have, and so it's certainly an additional challenge. Like I know we had the IPO panel earlier. I work a lot in the IPO space as well. At the moment, the number of pre-IPO companies that are picking up the phone, calling for IPO preparation services or audits is at an all-time high. I've never seen anything like it. And I'm telling most of these companies, don't underestimate this audit. This audit could be the long pole in the tent for your timeline when you go public. And it comes down to the risk appetite of a lot of the firms, the auditability issues with DeFi. Do you have SOC 1, SOC 2 reports on certain exchanges that are out there? But that's kind of the angle that I wanted to take this question. So
Yeah, I like Reza's point. Audits are very, very expensive, everybody. You should be paying a lot for your audits. They're very complicated, and they take a very, very long time.
Thanks, everyone. Thank you, everyone up here. Oh, we have time for one more?
We don't have time for one more, but just on that point, Cryptio has published a market structure report, and it seems like what Genius has done for the momentum around stablecoin accounting, maybe a market structure bill, and how that goes down over the next several months will give some clarity around how at least some DeFi protocols can be included in certain categories, which can then help accounting regulation. So keep an eye out for that DeFi report. There's a physical copies flying around in the lunch area. But yeah, I think we're at the end there.
Yeah, thank you.
Thanks.
Everyone.
Thank you.
Thank you.
thank you.